Axis, sharp move higher yesterday in the MFI space. This is, of course, also as a result of numbers. Bajaj Consumer, phenomenal numbers. And again, the stock went up very, very sharply. And there was Canada HSBC Life, which was the other one, which was up 10% in trade. Any thoughts, coverage, or view on any of these three?
Yeah, I think the names that you take, credit access results have been improving. The cycle for the MFI space, that is seeing some improvement, and definitely I think we are at the cusp of at least the bottom out process for the space is started to happen, and some of the names that we are liking from that space. Even today, if you look at, we have upgraded a Bandhan Bank from a neutral. For last 5 years, we have been having a neutral rating on Bandhan Bank. Today, we have upgraded the stock to buy within the same space. Valuations look very reasonable. FY27, we expect Bandhan Bank ROAs to see a strong recovery from about 0.8% to about 1.3, 1.5%. And so with the improvement in growth as well as profitability, we believe that the bank trading at less than book definitely has a lot of room for upside. So Bandhan Bank is something that we like from that space. We have just upgraded to a buy with a target price of 175.
Okay, all right. What about PNB Housing Finance? That one yesterday came in for a sharp knock. The street is divided out there. Some believe, the observations with regard to that fraud that was reported, could dent sentiment. Well, others say this was already known. This was a few years ago, and there's adequate provision. Yesterday, the street didn't buy it, though. Stock was down 8%. I believe the stock now trades around 8 to 9 times. So valuations are in favor. And we have, new person at the head. So what's your view on the stock after the kind of correction we've seen?
Yeah, Nigel, I think there is a transitory bump that we're seeing in PNB Housing Finance, NIM pressures as well as elevated payments, weak loan growth, and despite that, asset quality has been kind of stable. So what we expect going forward is that the transitory bumps ahead in the form of NIM pressures that we believe could see some improvement from the emerging and the affordable segments that could see deliver a healthy retail loan growth of about 17% over the next 2 years. NIM stability, that is something that needs to be seen, and that will be a key factor for the next few quarters. Plus, the new CEO now in, and we believe that leveraging on his acumen as an experienced mortgage lender, that could be another factor that the market will definitely watch out for. Yes, valuations are attractive. I think the execution is now the key. We definitely recommend a buy rating on PNB Housing Finance. We believe that the transitory hurdles, once the company is process these transitory hurdles, things should start improving. The bank should, the company should start delivering on the promise, and then market will start rewarding the stock.
Thanks for that. Sid, stay with us. Just a bunch more names, right, which went up yesterday and volumes went down. I mean, basically price moves with volumes is what Hormus focuses on. He's here with us. Hormus, take it away.
Good morning, Prashant. And Vari and Premier, of course, they continue to remain in the spotlight. Yesterday was Vari's earnings reaction. It was the biggest single-day move in terms of price action and volumes in the last 7 months. 9% higher on the stock yesterday. There was a top gainer on the Nifty 500 as well. Now, coming into yesterday's session, the stock had declined in 4 out of the 5 previous ones. And yesterday, we had close to almost 1 crore shares being traded. The 20-day average here is only 13 lakh shares. However, despite those 1 crore shares being traded, only 11% of those, 11.5% was marked for delivery. So close to 12 lakh shares were marked for delivery. The 20-day average is 3.5 lakhs. And the stock has been beaten down, almost 30% lower compared to its 52-week high. Eternal was the other one. At one point, the stock was up 7-8%, then ended lower by 2.5% in yesterday's session. There was very heavy trading activity seen there. and the volumes were the highest in the last 3 months. 15.5 crore shares were traded yesterday on Eternal, the 20-day average being close to 4 crore shares, and trading volumes worth over 4,500 crore in yesterday's trading session, and out of which 44% of that was marked for delivery, and close to 6.5 crore shares were marked for delivery, the 20-day average being around 2 crore shares, and the stock itself is down around 25% from its own 52-week highs. And talk about two extremes, both earnings not earnings reactions per se, but Bank of India was an earnings reaction, and Kalyan Jewellers continues to fall for the 10th day running. Bank of India was at a 52-week high. Kalyan Jewellers is at a 2-year low. And yesterday's session for Kalyan Jewellers, we had close to 2 crore shares being traded, and out of those 2 crore shares, 45 lakh shares were marked for delivery. And same is the case for Bank of India as well. Over 4 crore shares were traded yesterday. Now 4x its 20-day average, and out of those 4.5 crore shares, close to 1.5 crore shares were marked for delivery as well. So delivery-based buying seen in Bank of India, can't say the same for Kalyan Jewellers.
Thank you very much for that. We will get into a break, Harmis, and on the other side, we'll come back with the pre-opening rates. We'll also get in a few technical trading ideas. Sudeep Shah of SBI Securities, Mitesh Thakkar, as always, will join in. Welcome back. 20 minutes to go for markets to open. Yesterday was a good session. The Nifty managed to close with a gain of nearly 150 points, ending closer to above 25,250. Where do we go from here? Sudeep Shah and Mitesh Thakkar are now joining in. Gentlemen, good morning. Mitesh, let me start with you. Do you expect the rally that we had, the rebound that we had yesterday, to extend itself today? The GIFT Nifty is suggesting a flat start, but do you think it will be a stronger session?
Good morning. So I think, the index apparently to me has just declined a lot, has run away from the short-term averages, so it's just stopped falling. The idea that it's very oversold, and while the PCR also, was indicating that a couple of days back it's recovered a bit, but it's also towards the lower end of the typical areas from where the bounce back happens. So I still believe that on the upside, 25,400 remains the pivot. Until that has been crossed and we get a closing above that, I think the structure will remain weak and you will keep getting bounces of pullbacks. But broadly, if we don't get past 25,400, good chance that we'll not only retest 24,900 odd levels, 920, which is what we went low at, and maybe even break below that and head towards 24,600, 650. So that's the view. But keeping a close watch on 25,400, which was also the high, intraday high yesterday.
Yeah.
Sudeep, what would your Nifty call be?
Good morning, Rima. Rima, see, what I feel is that 25,450 for me will be a very important resistance to cross, because that were pivot points on 12th of Jan, as well as the fall started on 20th of Jan from the same level. So 25,450 for me will be a crucial resistance. And I feel it's just because of the oversold nature of the markets, we may see some kind of a mean reversion move, but nothing too bullish about it. But overall, the range will be 25,100 on the downside and 25,450 on the upside for today as well as Tuesday. That is what I feel on Nifty.
Sorry, what is that level?
Good morning, Prashant. Prashant, it would be around 25,050, 25,100 on the downside. That would act as key supports.
Okay.
And on the upside, 25,450, 25,470 will be a critical resistance to watch out for.
Got that. Mitesh, you'd look for longs or be careful still?
Still careful though. I think on individual stock basis, we have had some long positions because a lot of stocks have come to support. Some stocks are not falling in the declining market. So today I have a call on APL Apollo. I think, post the numbers, it bounced back pretty strongly from the 34-day moving average area. I think this should see further upsides. I would look at targets in the range of about 2030 here and recommend a buy with a stop below 1949. Similarly, FMCG is doing well. If you look at, Dabur, Godrej Consumer, etc. So Dabur is one which I've chosen today. If it gets past 527, 528, which is the intraday pivot, buy with a stop at 519 and look for target of 545. On the sell side is SBI Life, sell below 2015, keep a stop at 2040, look for targets of 1960, and Novama is a sell as well. Keep a stop at 1403, look for targets of 1340.
Sudeep, what about you?
A couple of buy calls. The first one is Indian Bank. Yesterday it had its results. The results were very good and we've seen a breakout above all previous highs. So here we feel that there's a strong long build-up backed by good results. So 870 will act as a stop loss on the downside, and we feel the levels of 940, 950 could be the immediate targets here. The second stock that we like is BEL. Now this stock from the defense pack is the only name which has outperformed the entire defense index, as well as it is holding its key level around 405, 400 levels on the downside. Any dip towards that is acting as a buying support. So on the weekly charts, there is immense strength, and we feel that 407 will act as a strong support that can be the stop loss also. And on the upside, the targets of 430, 435 are likely in the coming week.
Okay. Mitesh and Sudeep, thank you very much, both of you, for joining us more later in a bit from now. Well, let's shift focus and let's talk about the MNHCV, that is medium and heavy commercial vehicle segment. Ashok Leyland is reviving its Taurus and Hippo truck range, marking a re-entry into the CV segment. My colleague spoke with Sajeev Kumar, president of the MHCV segment, on the need of the hour for the industry and, of course, the company's outlook for this coming financial year. Listen in.
Last quarter has seen government really showering all kind of support for CV industry. We talk about GST rationalization, we talk about interest rate reductions, and then, as you rightly mentioned, government focus on capex infra is really very high, and we are seeing huge investments coming on infra, both in terms of roads and other infra which is getting created, and this is really helping the industry. So beyond this, I think the major challenge which industry sees right now is average age of the fleet. That average age used to be somewhere around 8 years. Now it has gone to 11 years. This to me is worrying factor, because a lot of old vehicles are there in the I would say which exist today. And when you look at cities like, let's say, NCR, we keep hearing about the air quality, we keep hearing about the pollutions. So I think government needs to come out with something which can really help address issues related to pollution, issues related to the overall age of the fleet, and maybe industry along with the government can create a an approach which can really incentivize these operators to move towards replace their old fleet. And once this happens, I think it will help the overall industry also, it will help the logistics sector also, and hopefully address the pollution issues also. Quarter has completely changed the scenario, and I think we went through a huge growth and momentum in quarter 3, and we are seeing the signs where quarter 4 is going to be equally good. So I would say that if you recall, 22-23 went through a huge period of growth. Almost 46% growth was witnessed by the industry in 7 to 55 ton, and then we were kind of stagnant with plus minus 2 to 3% kind of growth. But this year itself, we expect the industry to grow at least 8 to 10%, which is very good as per CV industry stand. standard, and I feel that this momentum is going to continue next year also. So I would say good days for CV industry.
Yesterday, there was a Nomura upgrade or a bullish note coming through on MHCV with names like Tata Motors, Commercial Vehicles and Ashok Leyland. And Ashok Leyland, I think, did well yesterday. It was up close to about 3.5%. In pre-open, Home First Finance looks like it's going to have a pop to begin with. Numbers are strong. Bottom line went up by 45%. And Bandhan Bank, too, could open with strength. And Zensar and Coforge are the other two mid-cap IT companies which should have some green as they begin trade. Siddharth, lots of mid-cap banking numbers have come through. Now, the expectation is that banking numbers will lead the recovery. NIMs are close to bottoming out, etc. What is your overall analysis of the banking numbers in line with estimates? What were the key trends that you've observed? And your top pick?
Rima, I think if you look at a lot of the banking numbers are clearly showing that the credit growth is definitely picking up. NIMs are bottoming out. And if you look at even on the cost side, there is a lot of control that is being put in, and plus on the funding side as well, the CASA contribution is improving specifically for large banks like HDFCs, where that was a big concern. So overall, we believe the large banks that will continue to do well. For example, we continue to like ICICI, HDFC and SBI from the large cap side. Mid caps are seeing a lot of enthusiasm. They are seeing a lot of improvement in growth. Again, there's something like a AU Small Finance Bank and Federal Bank. These two are our top preferred picks from the private banking side space. While on the PSU banking side space, I think Canara Bank as well as Union Bank, these two would prefer among our top picks.
Sid, a point taken. What we're going to do, Sid, stay with us, is play out some of the big corporate voices that we got from Davos yesterday, and a bunch, right? So we had Bharati's founder and chairman, Sunil Bharati Mittal, on a bunch of things, but tariffs, and he put it very sharply. He said, well, tariffs, the guidance was 300 rupees in ARPU, and that was about 8-9 years back, and he's still kind of sort of eyeing it. Of course, with inflation, that aspiration should have been much higher. But, well, he's not looking to bump that number up in terms of an aspiration, but saying, well, it should come, it must come. Listen in.
For $200, you're giving everything away. Just to win more market share is unsustainable. Something has to give. And we are seeing now from 12 operators, we are down to 2 operators plus 1, which is trying to make a comeback. I personally believe time has come for this to be a crowdsourced event where the whole country can benefit from a very strong digital infrastructure highway in which everybody is contributing 20-30 rupees a month to consume a ton of data and enjoy many services that they need for everyday life. So I think I'm hopeful that sometime in 26, we may yet come to the point of touching 300. We have always said 3+1 is good for India. It's a large country. World over, you see 2 or 3 operators. But for the size of India, I think 3+1 is a good place. And we are hoping that Vodafone Idea will start to, be more active in the marketplace. They are welcome. There should be 3 operators. Keeps everybody, in the right place from the customer point of view. And from our own standpoint, we are hoping, we have written to the government that AGR was our issue as well.
Yeah.
And we hope we get attention from the government.
Have you heard from the government at all?
No, not as yet. We heard from the minister yesterday. He mentioned that everybody needs to follow the route that Vodafone Idea followed, which is via the courts.
Okay, well, that's Sunil Bharati Mittal. Now, the country's largest oil marketing and refining company, IOC, chairman, spoke with my colleague Shireen as well. The big fear with oil marketing companies has been whether the government will increase excise duty. And the chairman of IOC addressed this issue. Listen in.
One overhang that continues to weigh on your stock is the possibility of an excise duty hike. Is there any indication at this point in time that that is likely, given the fact that we've seen crude oil prices coming off so sharply?
I don't know from where these things come. I have no indication of it. And to make it very clear that it is a very simplistic view that is propagated that if crude prices are so and so, the pump prices will be so and so. If it is $100, then the prices will be high, and if it's $60, the prices will be low. please understand and please propagate this, that it is not so simple, because the more important factor is how the cracks are working in the international market. What I am getting by processing 1 ton of crude or 1 barrel of crude, how much of MS or diesel I get it, and how much is that differential going there. That differential is what is affecting the prices on the pump, not the $65 or $100.
Okay.
So it is not a very simplistic thing to say.
So you're saying unlikely or not in the offing or not at all
I have
at this
no
point
indication
in time?
at all as of now, that much I can say.
Well, Shireen also spoke with C.S. Sethi, Chairman of State Bank of India, on the surge in foreign investment coming into Indian financial names, both banks, of course, NBFCs as well. And what's next? Listen in.
One is the foreign investors are much more confident about the Indian banking system today, and they're willing to bring substantial capital to that. And some of these banks where the FDI is coming in have the potential to scale up their operations with the capital buffers, what they can create. I think it's a very good development in my view. I don't think we are in need of capital at this juncture. And we also have very strong internal accruals, the capital augmentation which happens through the probability of profits is significant for us. So, and we are also planning, as you are aware, the divestment in SBI AMC. So that will also be capital augmentative for us.
Okay, those are the 3 big top voices as far as corporate India is concerned. All 3 nifty companies. Well, shares of IIFL Finance fell sharply yesterday. Remember, the company reported a great set of numbers, but communication from the IT department that there is a special audit which is to be conducted, I think spooked markets. This morning, the stock is up 2% at the end of the pre-open session. So Nirmal Jain, founder of the IIFL Group, came on immediately as the results came and this news broke. So just want to play out a quick soundbite. He, of course, called it entirely procedural.
Section 142A is for complex accounts. And in our case, when the gold loan business has more than 6.5 million customers, obviously that requires certain, and this thing is very procedural. And whenever after search they do a block assessment, they do it for 6 years. So there's nothing unusual about it. And in terms of the block assessment period, I think we have done the reassessment, and there's 1.2 or 1.3 crore rupees of tax has been paid. But other than that, I think anything is speculation, because the special audit, if you read 142A, it talks about accounts or inventory valuations which are complex. That's the time they do the special audit. Or that is when, if department is not able to do with their own resources, they can appoint a chartered accountant. And so, a CA firm has been appointed. They've been given mandate for 60 days time to submit the report. In the income tax search, the standard procedure is this, that there's a search department, they make the appraisal report, we just send it to central department. And based on that, they basically ask you to submit the revised return. And then when the revised return, the assessment and everything is done for a block of 6 years. So there's a revised return that we have submitted for, and we have paid them some small, it's a very nominal amount of extra tax that we have paid. And when the assessment department, when they have complex accounting or whatever, then they can appoint a special auditor. But as far as we are concerned, we are, as a company, we are 100% confident that there's no further liability we expect on this account. I don't think there's any business restriction or penalty will come from this. So what happens is that income tax department, once they got a special audit report, based on that, they can accept our revised return or they can challenge it. If they challenge it, then you can go and appeal. And so there's a procedure for that, but I don't think any penalty or any business disruption we can is legally permissible under this.
Well, the management reiterated that it's all procedural. They went on to say that under Section 142(2)A, the tax department appoints an independent chartered accountant, as they've done in their case, if they find the accounts too complex. But it could be a bit of an overhang. Yesterday's stock was down 15%. Pre-open suggests that there will be a mini rebound of about 2%. Mitesh is back with us for his 9:10 call. Mitesh?
So, I'll go with a buy on APL Apollo.
APL Apollo. And numbers are also looking strong for APL Apollo. But Gaurav, it's over to you now for Paytm and Aditya Birla AMC. What is the brokerage call?
stocks will be on our radar, and this is from the brokerage's point of view. First is that Paytm, because Investec, they have now initiated a report with buy rating and a target price of 1,550 rupees, which suggests more than 20% upside even from this level. What they're saying is that company has a tech which is very capable, and at the same time they have strong merchant relations, and that is the reason why the structural support for the company is very strong. They also believe that the merchant acquisition is already done for Paytm, and this will actually help the Paytm because the digital first model helps the Paytm to get as a substantial operating leverage in the business. Lastly, based on all these factors, they are forecasting around 23% growth in the revenue, and at the same time margins, the EBITDA margins are likely to go almost to 24% versus what it was at 8% in first half of FY26 according to Investec, and that is the reason they have a buy call on this stock. Other than that, Aditya Birla, AMC, now Citi has upgraded the stock from sell to buy, and they have also given a target price of 900 rupees. Now, what Citi is saying is that for the last few months, we have seen the performance was a bit tepid, and this was because of the weakness in the performance of the equity schemes. But now the performance has been stabilizing, market share has started stabilizing for the company, and this is a key reason why they are actually upgrading the stock. What they're saying is that they're seeing some equity flows which are improving and also sustaining for the company, and they are also expecting these flows to continue. Lastly, if you look at the management commentary as well, management has indicated that there will be reduction in redemptions and there will be flows, net flows, which will increase, and that is the reason why what Citi says, in fact, the execution still remains a key, but the aggressive sales engine and sustainable performance trend are likely to push AUM further, and that is the reason why they have upgraded the stock to buy. So all in all, both these stocks will be on our radar on the back of the bullish call coming up from brokerages.
Thanks a lot for that, Gaurav. Well, I'm focusing on APL Apollo Tubes. The numbers came in yesterday and the street really liked it. What did the street like? The EBITDA per ton sustained above 5,000 rupees for the second consecutive quarter, with volumes at around 920,000 for the past quarter. And the December run rate as well is going at around 1 million tons. So the street clearly likes that on a quarterly run rate, 1 million tons. The other factors as well, net cash of around 560 crores. The net working capital days remains very sleek at around 3 days. Those are the other data points as well the street liked. And now they have confidence. Existing capacity is 5 million tons. They've laid out the roadmap for another 3 million tons odd, and they're proposing that the capacity by 2030 goes to 10 million tons. So they're clearly seeing a good runway. The management, they went ahead and they've gone and raised their EBITDA per ton guidance for the fourth quarter as well as for FY27. Now they're working with around 5,500 rupees. That's an upgrade from around 5,000 rupees at their upper band that they were guiding earlier. They also stepped up their volume growth guidance to around 20%. But all this together, brokerages like what they're seeing, whether it's UBS, Equirus or Nuvama, they've tweaked their estimates, and some of them have tweaked even the multiple that they're willing to give. A case in point being a Nuvama, they have upped their multiple to around 40 times. So put everything together, APL Apollo Tubes, one of those few stocks that are at a 52-week high, and the street is clearly differentiating the men from the boys right now. Market leader, stock opening up in the green.
Okay, well, I think we've got the first rates coming up on your screen anytime now. 25,330, down about 0.1, up about 0.2%. So it's a continuation of the move from yesterday, but I mean it was not without, of course, setbacks intraday yesterday, right? I mean up and down. Sold off at one point with only about 20-30 points left, and then we finally ended with 150-160 points on the index. 25,300, so it's now gone flat. 20-point change. The Nifty Bank is up 0.2, 59,300. The Sensex is absolutely flat, 30-odd point change. Mid-cap index is turned red. But just 10 points lower. The small cap index will come up as well on your screens now. So that's that. I mean, it's 2:1, at least for now, in terms of market breadth. Advances to declines. So it's a decent start. So 15, 16 names are higher, but the rest of the names are lower. There's Trent and Dr. Reddy's on one end. There's Indigo, Adani Enterprises, and ONGC on the other end of the screen. And it's an absolutely flat kind of open now with a 1-point change to show for it. So that's the Nifty heat map. But I guess individual names, single stocks, lots of action. Rima.
Indeed, but you would have liked to see some follow-on buying after yesterday's up move. Week to date, the Nifty is still down 1.5%. The mid-cap index is down 2.8%. Sectorally, this morning, it's IT and metals where you are seeing buying. Both the indices are up 0.5%. Banks are managing to hold up in the grain, but just by a sliver. Some capital goods, capital market plays are up and about. On the way down, realty continues to get hit. Nifty Realty Index is down 11.5% since the start of 2026. So after last year's underperformance, realty continues to remain subdued. Talking about gainers, Dr. Reddy's was the big mover yesterday on the back of its Q3 positive surprise. Stock continues to see buying, 1.5% up. In IT names, it's TCS, Tech Mahindra, where there is interest in the large cap space. Emphasis came out with numbers, steady set of numbers, and stock is seeing some buying. And we should pull up a Coforge as well, because that will be reacting to numbers. Numbers are fine, bottom line impacted by the new labor code that has impacted the bottom line. But Coforge has been a rank outperformer, and they still have to digest the large Encora acquisition. Hindalco, HDFC Bank, Geo Financials are some of the other big movers. On the way down, Interglobe Aviation has taken a knock this morning. Operationally, numbers are resilient, but the bottom line has been hit by a one-off of 1,500 crore rupees, and stock is weak in trade, nearly 2% lower. SBI Life, HDFC Life, weak in trade. Eternal sold off 10% from the day's high yesterday. Maybe the street didn't like the leadership change and the transition, and Eternal is seeing another day of red right now, 1% down on that.
Well, that's right, Rima. Plenty of stocks doing a thing of their own in today's trading session. Just pull up a couple of these names. Hindustan Zinc, that's following the surge that we're seeing in zinc price. I think we're nearly around $100 per ounce. So that moves in tandem with that. I'll keep an eye out what the promoter entity is going to do, because at these lucrative prices, will they come in there and sell a couple of percentage? Well, we'll keep an eye out on that particular one. What else? IFL Finance, clarification coming in from Mr. Jain. You're on CNBC TV 18 in closing bell yesterday. The street's taking note of it. Yesterday, it made a low of around 515 rupees. Today, at around 550 rupees. So clearly, the street is willing to look through past this, at least as of now. We have Tanla as well. The stock, in fact, is up close to around 5%. Good volumes is what we're seeing on that particular counter. So that stock, in fact, up and about in today's trading session. 6.5%. Big move. Volumes as well, fairly decent. Suryoday Small Finance Bank. That stock is getting a bit of a knock. It's down. I think the NPA is moved up to around 6.7%. That compares with around 5.9%. So on the back of that, stock pulling back. Suryoday Small Finance Bank. Let's get that up, 5% down on that particular name. Tanla, by the way, is reacting to its results. So that explains why that stock's doing well. GSPL, revenues declined by 2.5% quarter on quarter, and EBITDA as well was down 1.5%. So that's down, I think, close to around 4% in initial trade. Net, it's a start in the red. Par for the course, one would say. You want to break yesterday's low, and from a bullish perspective, you'll want to get past today's high as well. Prashant.
No, it's absolutely. I mean, it's a tentative start, right? We'll see how it goes. But point is, you're also now going into a 3-day weekend. Monday is a holiday because of Republic Day. So when we come back on Tuesday, there will be 2 days of global markets to react to. And then, of course, you'd be right. Right, you'd be sort of standing right before the budget, which is on that Sunday. Lots of cues, I guess, to deal with. On the downside, I want to take a quick look. Premier is down 3%. Syngene is down about 2%. Bharat Coking Coal is coming up with some volumes, not very large, but it's number 4 in terms of volume-led losses, 2.5% lower, about 37.38. Lodha is coming up with about 1.75% cut. Radico went up sharply, is down about 2%. Gokuldas is down 2.5%. Gokuldas ended up about 6%, so there is some profit booking. We had EPAC Prefab yesterday joining us. Stocks down about 2%. Vari went up like a rocket yesterday, 2% lower. So yeah, it's tentative, and I think all these silver ETFs, right? Silver and gold ETFs, we should once again have them at the bottom of the screen. So the number one volume-led gainer is the silver Bs, 9% higher. The Starter Silver, Gold Bs, you name it. It's all that entire pack. Look at that. Just complete U-turns after yesterday. Silver, of course, underlying silver prices have seen a very sharp move once again. Hindustan Zinc, Nigel mentioned 4%. Hindustan Copper is up 2.5%. IIFL 3% higher. Bajaj Consumer went up, I think limit up yesterday after the results, 3% in the green. So it goes. 20 points lower. is what you have. Najib.
Just one stock, APL Apollo Tubes. We didn't highlight that. In a market like this, a stock that didn't do anything for very, very long. I recall the promoter entry came and sold a small chunk as well. And the stock, just absolutely didn't do anything for the last few years, actually. It did around 1,900 rupees and then it didn't do. Today, in fact, it's making that point. Separating the men from the boys. We had the smaller names, High Tech, JTL, all of them came and raised some money. But this one has held its own. It's making a fresh 52-week high, and it's reported its best earnings, in the last 2 quarters. So I think quality now is going to be standing out from here on. The largest player and stamping its authority. And
Aditya Birla AMC, another stock that Gaurav was earlier highlighting, the double upgrade from Citi. Aditya Birla AMC has also started trade with a gain of about 5%. It's been an underperformer compared to the other AMCs, both stock-wise and even in terms of financials compared to ICICI Pro AMC, HDFC. But Citi now betting double upgrade now on this stock.
Harsha Upadhyay is with us, Chief Investment Officer at Kotak Mahindra Asset Management Company. Harsha, great to have you with us here. Thanks very much for joining us. It's been, this week was, and actually the end of the previous week and the beginning of the first few days of this week just looked very painful and gripped by fear. Of course, as we end this week, it's looking a lot better. But is it going to remain a little better relative? It's all relative. Or you think we are still not out of the woods and there will be these bouts of severe selling? What's your sense?
Good morning, Prashant. See, as far as market is concerned, it seems to be more of the same. The volatility has continued into 2026. We are in the middle of the earnings season. Earnings season is expected to throw up a decent recovery compared to first half, in our opinion. It will not be very, very significant uptick, but definitely there will be signs of improvement in terms of earnings trajectory, at least for the large caps and certain mid caps in our view. That should help markets to take some support at lower levels. However, when you look at international news, that's not been great. Every few days we have been hearing some negative of the other. So to that extent, given the fact that valuations are still at around long-term averages, and the fact that earnings are still at the nascent stages of recovery, we are likely to see a similar kind of market movements over the next few months as well.
Harsha, where do you stand on realty? It's been such a tough beginning to 2026. The index is down 10%. Individual stocks are down so much more. What is the call you all had on real estate? And now, given the underperformance from last year and now, including 2026 so far, would you have a relook at real estate?
Rima, we have been underweight on real estate sector for quite some time now, and that has worked out quite nicely. As you mentioned, it has been a relative underperformer to benchmark until now, at least for the last 5 to 6 quarters. Now that we have seen significant correction, probably one can look at selectively betting on certain real estate names. However, one should also remember that probably we are in the 6th year of upcycle in the real estate market in India. So to that extent, we would be taking a little bit of risk in terms of a continuation of that cycle. Historically, the cycle has continued for 8 to 10 years. So definitely we are past the halfway mark in terms of the upcycle in real estate. So I don't think at this point of time we would take a very, very large top-down view on the sector. Rather, we would look to invest selectively if the correction continues.
Hi, Harsha. Good morning and good to see you. And Harsha, the last couple of weeks, people have actually got even more fearful. Earlier, at least, there was that bravado that was playing out. How do you see things play out? If someone who's looking at allocating money, what would you tell them? That bulk of the bad news is in the price? Or do you think that still things are very, very skittish, both on the domestic as well as on the global front? And we've already fired quite a few bullets, both from the center as well as from the RBI. So what would your advice be? Bulk of the bad news in the price? Or is this still turning out to be a very, very uncertain couple of months?
Nigel, if you look at markets from September 24 onwards, it's been either declining or sideways for most of the period. So to that extent, I think time-wise consolidation has happened. If you look at the valuations, the large cap valuations are almost at long-term averages. If you look at mid caps, while it is slightly higher, the expected earnings growth is also likely to be slightly better than large caps. The real risk, however, still continues to be in small caps, which we have been highlighting for more than a year now. the valuations are almost 40 to 45% premium to long-term averages when you look at the index valuations. Over the last 5 or 6 quarters, there have been at least 2 or 3 quarters where the small cap earnings have actually declined. Forget about the expectations of 20-25% growth. They have not even given positive earnings growth. It's been a decline. So to that extent, the valuation risk in small caps is still very, very high. And in this quarter as well, we are unlikely to see any significant pickup in small caps vis-a-vis large and mid caps in terms of earnings trajectory. So to that extent, I would say that while markets have consolidated well, it's better to be in large and mid caps. Depending on your risk profile, you could choose a different proportion of large and mid, but it's still better to be in large and mid rather than focusing on small caps at this point of time.
Harsha, budgets in the past, if you look at the last 10 plus years, they've marked a decisive shift. Earlier it was capital goods, defense, etc., and the kind of spending, and that decided the way capital allocation was done, which were the outperforming sectors. Then there was a marked shift towards consumption, boost to rural as well as urban consumption. In this budget, do you expect any sort of a turn which can dictate the way money needs to be allocated?
No, it doesn't seem like, Rima. If you look at nominal GDP growth expectations, they are likely to be somewhere in that double-digit band, early double digits. So given that and the fact that the government is going to keep an eye on fiscal deficit, and probably we are going to see a 10 to 15 basis points of lower fiscal deficit number for the next year, and the likely fact that possibly you will also have a glide path towards a lower debt to GDP numbers, etc. It's very difficult to assume that there will be very large capital expenditure plans from the central government. In an absolute way, yes, it will still be a very large number, but on a year-on-year basis, you are likely to see maybe early double-digit kind of growth. And most of this is going to go into some of the sectors such as defense, renewables, manufacturing, and all of that. So it's likely to be more of the same in terms of the policy push, in our opinion. And of course, consumption has got some structural benefit through lower GST numbers. And even without anything specifically in the budget, that should continue to get some boost.
Harsha, just 2 questions. One, what are you telling investors, distributors, etc., with regards to what people should do with gold and silver ETFs? Right, that is one. And the other is, ICICI Pru AMC recently, actually they started accepting lump sum into their small cap fund starting today, with effect from today. Across industry, you included, right? I think you were one of the first to stop inflows, March of 24, I believe. So any rethink? I know you just said valuation discomfort and maybe large caps are better, but just your thoughts there.
Prashant, on your first question about gold and silver, we continue to remain positive on both of these asset classes. However, one should keep a prudent asset allocation in mind when you are looking at any of the asset classes, and especially the asset classes which have done so well over the last 12 months. For example, gold is probably up 70-80% over the last year. Silver is up almost 3 times in a span of about 6 or 7 months. So to that extent, anything which has moved in a vertical fashion, in a parabolic fashion, is likely to see volatility even without any fundamental reasons. So to that extent, any aggressive investment at this point of time comes with a lot of risk. However, given what's happening in terms of global trade and commerce, in terms of geopolitics, in terms of world order in general, we do believe that precious metals will continue to see a reasonable uptick. However, one needs to have a reasonably long-term outlook and also needs to make staggered investments rather than jumping in the fear of missing out. I think that's the biggest issue that one has to contend with at this point of time. As far as small caps are concerned, clearly our view remains that they are quite expensive. We are not stopping subscription of our small cap funds. However, we are clearly communicating to our investors and partners that probably it's better to be in large and mid caps in different proportions depending on the risk profile at this point of time, rather than taking focused small cap exposure. However, even when you take diversified exposure, you are likely to get 5-10% kind of exposure to small caps, which will be more of bottom-up selective opportunities that the portfolio managers would bet on. And that's sufficient enough to take an exposure to small cap at this point of time in our view.
Harsha, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC TV 18. Well, we want to talk about our first corporate in the program. Coforge is the company I'm talking about. The reported numbers, and it's been a beat across the board. Revenues, margins, both slightly better. PAT, though, impacted by exceptional loss. We are joined by Sudhir Singh, CEO at Coforge. The last conversation, Sudhir, we had was, of course, extensively around the Encora acquisition and what you're going to do there. And just want to, and we'll get to the numbers in just a bit, Sudhir. I think you've told investors that in terms of financing that, you are very close to finalizing that loan and there is no need for a QIP. Can you just tie that in terms of the financing of the acquisition?
That's absolutely right. When we spoke last and on the 26th of January, we said that we might consider a QIP for retiring the $500 million debt that's on the company's books. We have been working with a consortium of banks. We have secured a rate of interest which we found extremely attractive. It's somewhere around the mid-single digits. And therefore, we will not be doing a QIP and the associated equity dilution. We will be going down the loan route. And we remain committed to what we said earlier. There will be no EPS dilution as a consequence of this loan assumption as well.
Yeah, I mean, equity is more valuable, isn't it? Sudhir. Rate of interest, you said, where are we at on this?
Mid-single digits.
Okay, mid-single digits. Anything else, just to tie in the Encora bit from the last time that we spoke, any movement at all or all proceeding smoothly?
All proceeding smoothly, all proceeding as per plan.
Okay. Let's get to, so no QIP. That's essentially the first headline that we want to put out. They're going to do the loan, $550 million, mid-single digit is the rate of interest, but no QIP, no dilution. So the numbers, as I said, I prefaced before I came to you, are good across the board. They're beaten expectations. On the BFSI side, though, which is a significant portion of your numbers, there is a bit of a degrowth. Could you start there? What happened in the quarter?
Well, the quarter, this was a seasonally short quarter, as you know, Prashant. We've closed 6 large deals during the quarter as a firm. 2 out of those 6 large deals have come in on the back of from the banking sector itself. And in the investor call that we closed just about 15 minutes back, we've told the investors that next year, given the large deal momentum that we are looking at in Q4 and beyond, we believe that BFSI has a very good chance of possibly being the fastest growing vertical for us in FY27. So we feel very good about banking financial services. And quarter 4 onwards, that reversal should be very visible.
And overall, FY27, considering your executable order book over the next 12 months is up 30%, what should we expect in terms of organic growth? And when will the Encora acquisition close? And how much can that contribute in FY27?
Sure. So as you're aware, we don't offer revenue guidance. But in the investor call earlier today, we said that we believe that FY26, and you know that YTD we're growing 32.8% at the end of quarter 3. We believe FY26 has been a very good year. And we believe very strongly that FY27 is likely to be an exceptionally good year. That's how we've characterized the likely growth numbers that we see ahead of us. As far as the second question is concerned, the growth at this point in time is coming from all 3 core verticals. It's also coming, in our case, from the healthcare and the public sector outside India space. With Encora coming in, there are going to be a few additional growth levers. High-tech as a vertical, LATAM as a geo, 10 million plus accounts that gets added. So the intent, as we maintained over the last 1 month, when we did announce the Encora acquisition, is to not look at Encora and Coforge delivering the same level of performance as we have over the last 8.5 years, but to actually bend the growth and the margin numbers upwards from where they are right.
Yes, I remember you called it defining moment, which will accelerate Coforge's growth into a higher orbit. I think those were the words that you had used when you had made that acquisition. Tell us a little bit more about these new verticals, which are also doing very well for you. Healthcare, high tech, and this time your rest of the world business, which I believe, as you're saying, is the government leg of the business, has done very well for you. So how much can that drive the overall top line in FY27?
Healthcare and high tech together are already 10.5% of our aggregate revenue. That business has doubled over the last 4 quarters. The exact number, if I remember correctly, is 95% growth across healthcare and high tech. And this is all pre-Encora. With Encora coming in, we expect the growth to be on steroids going forward. The UK public sector and the Australia public sector again continues to do extremely well for us. In the investor call that we just concluded, we said that outside the 6 large deals in Q3 that we've already announced, there's likely to be a very big contract in the UK public sector in Q4, the quarter that we are currently in, that we expect to sign. So we feel very good about high tech. We feel very good about healthcare. We feel extremely good about the public sector outside India. And of course, the core verticals, including banking, are firing very, very strongly.
Yeah, and that guidance which you gave as the last time we spoke with regards to, just to go back to Encora, about 200 basis point margin expansion, that's very much on track. I mean, that is the aim still, right?
Absolutely is, Prashant.
What about margins, Sudhir? Because I remember in one of your analyst calls, you said that FY27 onwards, you'll stop giving a margin guidance. You had guided for 14% by this year end. You're on track to achieve it. But thereafter, you may not give a guidance per se, but 14% will be the floor on margins. Can you tell us what the company is likely to do thinking on margins?
We believe FY27 is going to be an improvement on the margin front over FY26. We don't give a revenue guidance. We will not give a revenue guidance in the future. We never used to give a margin guidance. We gave a 1-year margin guidance for FY26 alone. We've said that there will be no margin guidance in FY27, but we have committed to the fact that at a minimum, the margin on the EBIT reported front will be maintained where it is. And it will be our absolute intent to make sure that it doesn't just remain flat. It looks up incrementally and hopefully materially.
Hi, Sudhir. Good morning and good to speak to you after a while. Sabre, that's one of your key clients. Some are doubting that there is financial turbulence out there, which in turn could impact your business. What do you have to say about that?
Sabre was signed about a year back. In the first week of the current month, the leadership, including me of Coforge, had a 3-hour meeting with the CEO, CIO, CAO, the entire leadership of Sabre. The program is going swimmingly well. We are ahead of the delivery milestones that we set for ourselves. We've always told our investors to recognize that Sabre is likely to be only 4 to 5% of our revenue. Please do bake in the fact that this is a firm, Coforge is a firm that's growing almost 33%. So while we continue to partner with Sabre, and that partnership is going well, we remain very cognizant of all risk mitigation measures that need to be taken at our end. They are all in place. Delivery is on track. And we feel very good about where that relationship is and the risk mitigation measures that we have in place.
I asked you this last time as well, so they're going to ask Shweta as well when both of you came on about, because I mean, there is, I think the first tranche of shares eligible, I mean, the Advent can sell in, I think by June, right? About 50% of shares. I mean, and Shweta, of course, very clearly said they're in it for the long run and they're not here to sell or anything. No, any conversations around that? Any assurances, etc.? I mean, you'd understand, markets always, of course, have an eye out on that if there's large supply around the corner.
Prashant, we've had no conversation around this. And I suspect Advent is best placed to comment on it. From a regulatory perspective, they are allowed to sell 6 months post-closing, and closing at the current point in time appears to be likely to happen around April of this year. And they've also committed contractually to hold on to the remaining 50% at least till the end of June next year. those are the data points that we have at this point in time, and I'll defer to Advent to comment on their plans.
Yeah. I mean, the conversation with Shweta at Advent was not very old. And at that point, she had said that, see long-term creation, value creation with this investment. And that there are no plans in that sense. So I assume nothing has changed, but just wanted to ask you that. Sudhir, thank you very much for joining us. It's a pleasure having you with us on CNBC TV 18. Thank you for being here. Okay, well, that's strong guidance from the Coforge management. Exceptionally strong FY27, just what the markets would like to hear. And of course, they've done a very large acquisition with Encora. 1677, 1678 is where we're at. We take a break. We're joined by the management of Cyient. So technology very much in focus on the other side coming up.
Welcome back. Market's still flat, but the focus is on mid-cap IT companies. Cyient is the next one on our radar. It reported a mixed set of Q3 numbers. The company has achieved 3 consecutive quarters of improving sequential revenue growth. And the management in the conference call yesterday also spoke about achieving a 15% EBIT margin by Q4 of next year, Q4 FY27. That is for the main DET business. Sukamal Banerjee, Executive Director and CEO at Cyient, is now joining in. Thank you very much for joining in. Mr. Banerjee, you've said that FY26 will be a year of stabilization. FY27 will be the year of consistent growth. What kind of revenue growth should we expect for the overall business, all the 3 entities combined? And then if you could provide a little more detail about the digital engineering business, DET.
Firstly, good morning and thank you for having me. As you know, we do not give guidance. So from a perspective that you mentioned, which is with regards to how we see the future play out, definitely from our plan perspective, we would like to drive high single digit or I would say high single digit and probably on the borderline of double digit growth year over year is what our plans are. But at the end of the day, it is what our ambition and plans are, and that is what we are working towards. Our focus is quarter over quarter. As you know, we are a turnaround story, and we have been working hard on that turnaround. And some of the results are showing up in Q2 and Q3, as you have seen. And we have some ways to go, and we continue to be cognizant of that.
Okay, got that. So FY27, the aspiration or the ambition is to hit high single-digit revenue growth, borderline double-digit, but this is not a formal guidance that the company is sharing.
That is correct.
For Cyient. Got that. And particularly Q4, considering that there will be furloughs, what should we expect Q4 versus Q3?
So again, we do not give quarterly guidance as well, but we remain positive in terms of continuing our growth trajectory. And I'm talking about the DET business. From a semiconductor side, as you have seen, the semiconductor business has grown double-digit quarter over quarter over the last 2 quarters, and they continue with that momentum with a very increased order intake that they have announced. So I think overall, from a consolidation of Cyient DET and Cyient Semiconductor, which we report together, we should be on the growth trajectory.
All right. Hi, Mr. Banerjee, and good morning and good to see you in. What about bridging the gap towards that 15% guidance? I think it was towards the end of next fiscal. Tell us, how do you do it? And does that hold?
Yes, it does hold. So 2-3 things. Firstly, obviously, if you look at our numbers for the last couple of quarters, we have seen marginal increases. which is reflective of a couple of things. We took a very conscious decision that we are not going to slow down our investments as shifting our service portfolio and our market portfolio is a very important aspect to our midterm to long-term growth objectives. So if you have to achieve the numbers that I'm talking about from an ambition standpoint for FY27, it is important for us to make sure that we make those investments now. So we have continued to make those investments. We also took some restructuring costs in both Q2 and Q3. And those are reflective in the numbers that you see. As we go forward, while investments will not ramp up, there will be incremental ramp up on investments. The restructuring will go away. And that creates a tailwind for us in terms of margins, which you hopefully should start seeing from Q4 onwards. And we have to continue working through FY27. It will be a combination of our continued focus on cost takeout, on largely non-people cost, and also a combination of making sure that the growth in revenue that we are talking about leads to lower absorption of our overheads.
Mr. Banerjee, morning, Prashant here. Could you give us the performance, the loss from the semiconductor business in the third quarter and April to December? And when will this stop being a drag?
Sure. Firstly, I think we need to look at semiconductor business slightly differently. As you know, our focus on semiconductor is a product focus. It is not a services focus. And like in the early journey of any product company, there will be investments, and that is what we are doing. From a perspective of guidance, we shared about this in the investor call also. Our focus is to become EBIT neutral in FY27, and that's something we are definitely working towards ensuring. So as the business continues to ramp up and our investments play out in terms of revenue stream showing up, we are confident that's going to happen.
What are revenues now and late 27 or, I mean, in terms of breaking even?
So in FY27, yes, we'll be, so we are not talking about the entire year. Sometime in FY27, we will become EBIT neutral is our guidance.
And what will revenues be from this business in 27, approximately in the ballpark, just to get a sense?
I'm sorry, didn't get your question. Can you come again?
What will revenues be in this from this business in FY27?
Okay, so I think you have seen the revenue trajectory that they have demonstrated, which is double-digit quarter-over-quarter growth. And obviously, as the base builds up, that may be difficult to sustain, but we are confident about the growth trajectory they are on. We have many things in works from a perspective of their growth trajectory, and we'll definitely continue to see that number play out.
Okay, let's...
Just one more question on the semiconductor business. What was the loss so far in the semiconductor business at the EBIT level in Q3 or 9 months FY26?
I don't have that handy. We can get back to you. But I think, as I mentioned, our entire focus on the semiconductor business is what is our investment line and what is our revenue growth that we are driving. That is how we are managing that business, and we'll continue to manage that business for the time being.
Okay, all right. Since we're talking about this business, tell us about the deal signed with Kinetic Technologies. You're going to be paying close to around 900 crores, effectively doubles your target market. Tell us the funding of this, and will it be EPS accretive in year 1, year 2?
Yes, it is EPS accretive in year 2, and that's what we announced when we announced the deal. From a funding perspective, it will be a combination of cash and debt.
Okay, you want to give us the mix out there, and how much will it add to the top line in FY27 itself?
So from a mix perspective, it is something which it is to be determined as we get closer to our closure, which is sometime expected in April. That is when we're going to take the final decision. It will have a healthy debt component, and there will be cash as well. The exact split will decide at that point in time. And there was a question around the revenue. It is going to double the business that we have today in terms of overall run rate.
So when you give us that FY27 guidance of high single digit, maybe closer to double digit, how it will be aided by the some contribution coming in from this acquisition, Kinetic Tech. So can you give us a sense of what organic growth for the company will look like?
No, our numbers that I'm talking about is for the DET segment. Semiconductor, we report separately. For the DET segment, there have been no acquisitions. And the numbers that I'm talking about and sharing what in terms of our ambition is our organic growth. So as and when an acquisition happens, obviously we'll talk about it at that point in time.
No, got that. Fair point. Any more acquisitions that you're looking at for the other businesses?
Sure. I mean, we are continuously evaluating the market like anybody else in our business. As things change, as I said, we are a turnaround and a transformation story. It is important for us to make sure that we are changing our portfolio towards more higher growth areas. And we have consistently talked about in our investor calls as well as to the investors that it is important for us to make sure that we acquire higher growth sectors, which is largely around digital and data, which has a significant overlap with the business that Cyient does in terms of future transformation, as well as there are certain segments or industries in the market which are very big, where our presence is minimal, like automotive, like software, where we would like to definitely look for strategic transactions as and when they become available.
No, makes sense. Thank you very much for joining us. Good luck and hope to catch up again soon. Well, CAMS is the next company we want to talk about. They reported a decent set of third quarter numbers, strong growth in non-mutual fund revenue. EBITDA margins expanded by 135 basis points during the quarter gone by. Anuj Kumar, Managing Director at CAMS, is with us. We're talking about three things: outlook, of course, for 27, impact of mutual fund regulation changes, and growth opportunities in the non-MF business, which, of course, I mean, CAMS has regularly told us is growing much faster, will be a big area of growth. I want to start with point number 2. Thanks very much for joining us here, as always. Prashant, this side. Has there been a conversation with mutual funds in terms of renegotiating contracts? Because, I mean, you know, as we understand it, the discussion is, the effort from the regulator side is to, ask them to lower what they charge. So their cost structure perhaps under some pressure. So has that shown up in terms of your talks with mutual funds, sir?
Good morning, and thanks for having me over on the show. So you're right. The objective of the regulator is to make the product cheaper for the marketplace and investors. All the recent PR discussions, I think, will have, I wouldn't call it a marginal impact. It is not substantive, not marginal, but a small impact on the larger mutual funds. As we've always said, we are at the high end of value delivery for the mutual funds in terms of running the entire liability side operations. So we believe we deliver sterling value to them. Let this play out over the next 4 or 5 months. If we have conversations, we will see how they go. But right now, there is nothing that's happening right now on that front.
Right. Is that because of the nature of these contracts and when they come up for renegotiations, Mr. Kumar, or it's just that it's not happened? I mean, they're not clear yet, so they've not asked you or renegotiated their rates and what you charge them.
Yeah, so there are many puts and takes there. I would just cleave the market into 2 parts. One large part of maybe the top 10 mutual funds will see some impact on account of the exit load going away. The rest of them will see balancing out of the impact of the exit load versus what is positively accretive to them from the GST front. So if you take the top 10, they are perhaps going to see some impact. They're also evaluating, so are we. So this hasn't commenced yet in terms of a formal dialogue. The other thing, of course, you're aware is that our unit price comes down every year. So there are scale benefits baked in. The unit price falls almost every year, which I think is anyways in favor of our customers. There are very few marketplaces which operate like this. So when you put the impact of these 2 things together, we're just waiting and seeing whether they want to have a conversation on this or whether they have figured out ways to absorb this.
So you're saying 10 large, and you'd be dealing with all of them, mutual funds, will see some impact.
About 7 of them, yeah.
You deal with 7 out of the 10 mutual funds where there will be an impact because of the exit load going away. So they're watching in terms of how to navigate this.
That's correct.
And when will this renegotiation come up, sir? At sometime during this year, 26?
Yes. I mean, if they choose to come back to us, it'll perhaps be in a 3 to 4 month time frame.
Okay. So maybe in Q1 of 27 is when we should expect it?
Yeah, I would not set any definite expectation on it because the entire exit load is about 5 bips. They run pretty large P&Ls. But if it has to happen, it'll probably happen in the first quarter of FY27.
Okay. All right. Hi, Mr. Kumar. I think we've got some clarity on that front. So let's focus on the numbers then. Revenues year to date, I think, up are only around 5%, with margins being maintained in that vicinity of mid-40s. For the year, what kind of growth are you looking at this year as well as the next? And in terms of your share, you were telling us that the non-MF business will grow at a faster clip. So the contribution will gradually move up. Give us the guidance on that front as well.
No, sure. So if you see this entire year, I would just say that it is in the backdrop of a large price reset we had taken about a year back, about 9 months back. So year-on-year growth numbers for the quarter and for the year will be in single digits. That's point number one. Despite that, you would have seen that operating EBITDA from the first quarter of this year has climbed up from about 43 to 46%. A large part of that is just productivity delivered out of our technology initiatives, largely playing out. You would have seen the CAMS AI brand go live. I think a lot is happening in the base tech stack for us to get benefits out of that. The non-MF business for the quarter grew about 25%. A broad statement of the markets has been that this will grow ahead of the overall enterprise revenue growth. So we've set a 20% baseline. This quarter was better. When you look at FY27, we would not be comparing revenue growth with the larger base. It will be with the smaller base after the price reset. So we are expecting FY27, and again, this is not a formal guidance. We don't issue those. But we're expecting that revenue growth at the enterprise level should be about 12 to 13%. Non-MF revenue growth next year, FY27, should be upwards of 20%. And EBITDA, operating EBITDA growth should be upwards of 15%. These are broad indicative numbers. We don't issue guidances, but just the way we think the year will play out, all of that should be possible.
Right. So revenue growth of 12 to 13%, Mr. Kumar, that's what you're saying in 27?
In 27, yes, absolutely.
Okay. And since you're sharing those numbers and you said these negotiations will take place, is there any sense of how to think about the impact? I mean, worst case, base case, and bull case.
See, I'll give you a very broad indicative number at no percentages, only absolute numbers. We expect our revenue increase, absolute rupees, to be between 150 to 200 crores a year. If any of this happens, the impact could be about 20 to 25 crores annually. So it'll be a small fraction or a manageable fraction of the overall revenue increase that we get in a year. I think we are mentally prepared for any of these dialogues to commence. Like I've always said, that the amount of value, expanding value that we deliver to the market, we don't expect any dialogues with friction. They will be fairly amenable to listen to our side, to our expanding scope and the value we contribute. So it is not a in-the-face kind of dialogue that we're expecting.
Okay. So you're saying that worst case impact with respect to mutual fund negotiations led by this attempts to lower fees by the regulator annually could be about between 20 to 25 crores. I just want to get that right.
That's correct, in that range.
Okay. That's very helpful. The other bit, which is a more structural thing, of course, is this move towards passives, ETFs, and we've seen, of course, this happen in the Western world in a big way. And here, of course, I guess, many believe it will happen. And of course, their cost structures are much lower. So any thoughts on that? I mean, that is, as I said, a slightly longer driven theme. Will that have a sobering impact on your profitability as well?
It's a slow reset. It's a very slow reset. Whatever you've seen in the world of ETFs in the last maybe 12 months has been led by gold and silver. Hasn't so much been the impact of equity ETFs. I also believe, and as an investor, not as part of the ecosystem, as an investor, I see that in falling markets, actively guided mutual funds have given much better cushion to investors. So what we see is that about between active equity and passive funds, there is perhaps a 1% swizzle every year. That 1% swizzle has been there at this rate for about the last 5 years. If it stays that way, you could see about 0.5 to 1% of active equity give way to index funds and ETFs. And I'm saying net of the metals, this is purely equity. We are prepared for that because overall, as you've seen, the AUM growth in the market has been 20%. Last year, despite whatever has happened in the market, the asset growth for CAMS has been 19%. Within that, if a 1% swizzle happens, I don't think it is a material impact to our financials.
Got it. Okay, all right, sir. Thanks a lot for joining in and giving us that clarity. We look forward to chatting up with you rather soon and wish you all the best for the remainder of this quarter.
Thank you very much.
Well, it's time to slip into a short break. On the other side, we'll connect with the management of HDB Financial Services as there was a bit of a rejig at the top. Stay tuned. Well, the advanced decline ratio has turned in favor of the number of stocks declining. So that's telling you the markets are still very, very skittish. The good news is 20, 30 points down is par for the course. This market just needs to stop falling. That said, let's get to our next management. HDB Financial Services, that's in focus because Mr. Arjit Basu resigned as the non-executive independent director and chairman with immediate effect. He cites conflicts of interest as the reason to step down from the board. To discuss this, give some kind of a surety and clarity with regard to why the step was taken, we have Mr. Jaikumar Shah, the CFO of HDB Financial Services, who joins in. Hi, Mr. Shah. Good morning. Good to see you in. And, sometimes investors get a little bit rattled when someone at the top, moves on. You've given the reasons are out in the letter that you'll have put out. But, give us some clarity. Why did this take place? And the investors will be looking for some reassurance. So go ahead.
Sure. So firstly, let me, take a few seconds to just thank Mr. Basu I think he's been our chairman for 5 years. He joined same time as me, almost 5 years ago. Has given us absolutely invaluable advice, stellar guidance, and also took us through the IPO that we did earlier, middle of last year. I think as he mentioned, his term was coming to an end in a couple of months. He's looked at what potential options come his way. Mr. Basu in his letter has mentioned that he has a certain opportunity coming through as in a bank where his name has been put forth. As you would think, we work with all the large banks in the country, and given the kind of related party transactions that come up, scrutiny that comes up, Mr. Basu, again coming from the HDFC group, felt from a governance standpoint it's best that he takes a step back and does not have any questions raised. So that's the conflict that he potentially referred to. I think from a company point of view, we've absolutely had a great relationship with Mr. Basu. Mr. Basu also has acknowledged in his letter that the governance standards that the company has held has been very high. So that's how I would put it, not to read more than that.
Jaykumar, hi, this is Rima here. So when will the company appoint a new non-executive independent director and chairperson of the board? Have you identified anyone, since anyway his term was coming to an end?
So we are in the process. As I mentioned, we're part of the HDFC Bank group. I think the group goes through a very detailed process. We will work with our parent to make sure, we have a chairman in place soon.
Okay.
Any timeline?
No specific.
And have you
timeline.
identified candidates?
If you look at our board, we have 6 independent directors. So it's a very well, how do I say, a very illustrious board that we have of, eminent dignitaries. So I'm sure, with that board, we'll be able to function very smoothly in times to come.
Okay.
At the same time, the bank will, appoint a chairman.
Just some clarity. It'll be the replacement will be from within, or it has to be, from outside?
We have both options open. I think we'll work with the bank to do the needful. As I mentioned, with the parent with us, and strategy is very clearly laid out. Okay. From a smooth functioning of the company, there wouldn't be any, challenges as such.
Okay, all right. Since we have you with us, Mr. Shah, just wind this down with how things look going ahead. I think you'll be looking to outgrow the industry. So just give us some clarity on that. And there has been some various segments of stress, right? Do you think the stress is receding right now? Your reading of the situation. Please go ahead. Growth as well as stress in the system.
So from a growth point of view, as we've called out in our public calls also today, we look at nominal GDP and a growth above and over and above that, and we're fairly confident at this stage over the coming years that we will work towards that growth targets. Right. In terms of stress, there has been some stress in the past few quarters. Stress is receding, and it's visible through the numbers as well that we should be able to march forward well going forward.
Right. Mr. Shah, hi, morning. We have we had Ashok Leland with us this morning, right? We played out portions of an interview, and he said, well, for commercial vehicles, he said it's likely to be a great year. Now, your exposure to commercial vehicles is not small. I mean, it's, I think, significant, right? 40% is asset financing. CVs make a large part of it. Do you resonate with that view? And any thoughts specifically on that segment?
So, Prashant, the way I would look at it is we're very optimistic, but at the same time cautiously optimistic. Today, things change by the day. It's important that we, push hard and at the same time be resilient to the same. So that's the focus for us. I think Q4 has always been good for us as a company and the industry. And as we march into FY27, I think the focus will be to continue on that pace with the right asset quality as well.
Right. Okay. But relatively the pace is picking up for CVs, right? You'd give us that
That's
much?
Correct. That's correct.
Got that. We'll leave it there.
And quality is also improving.
Asset quality is also
fronts
improving.
is good.
Yeah. that's the feedback we get from elsewhere as well. But thanks for confirming it. Appreciate it. Good luck, and thank you for joining us for this short call and explaining it's of course why Mr. Basu stepped away. Another opportunity, basically. 711 is where HDB is at. Market's absolutely flat. But basically you got sharp turns, right? Look at just Gokuldas exports went up 6%, almost back to about 600 yesterday. A complete reversal, 5% lower, right? It's just that kind of a market where we are seeing and a lot more. So, I mean, the other big reversal, of course, is all these silver gold ETFs, right? Sharp 15% cuts yesterday, all back 10%, at least 10%, if not more. The other one is IIFL, is up 4%. We had the management with us, and they're saying, well, that special audit by the IT department is procedural. Stock was down 15. It's still down basically from before the from when the company reported results. It's down 10% still. But today it's coming back. Bajaj Consumer, big move yesterday. Another 3% on the back of numbers. APL Apollo is up about 3%. So some of what we identified right in the morning, continuing with gains. Ujjivan Small Finance Bank is another one which is up about 8% or so. But I mean, if you just look at the top 12 odd quotes, 15 odd quotes with volumes, it's all silver, gold. And you got a stray stock thrown in between in that sense. Market breadth is negative. Some 200 stocks, it declines outnumber advances by some 200 odd stocks. So it's not hugely negative or anything, but there is, that's where we're at. Eternal is the number one volume-led loss, 3% down on Eternal. So it sold off hugely from the day's high, and that cut continues. Actually, Swiggy is down about 2.5% as well. Well, it's a quick commercial break here, and we're going to come back with the management of Indian Bank on the third quarter numbers and outlook for 27. Lata will take that conversation forward.
Welcome back. Earnings season. So we continue with corporate trader. Indian Bank is on our radar. It reported a good 14% growth in loans and almost 13% growth in deposits, 12.6% to be precise. The bank's net interest margins improved quarter on quarter by 5 basis points. They now stand at 3.28. However, as in all other banks, net interest income and profit growth have been muted, both at around 7.5%. Joining me to discuss the results is Mr. Binod Kumar, Managing Director and CEO at Indian Bank. Mr. Kumar, good morning. Thank you very much indeed for your time. Would you say margins have bottomed, and going forward we can only see it inch up, probably 5 basis at a time?
Thank you, Lata, for having me here. See, margin, I will not say it has bottomed out, because the impact of 25 basis rate cut, which has happened in the December, impact of 2 months will come in this quarter. And also, if you see, after December, bulk rate has hardened by 20 to 30 basis points. So I expect there may be some moderation by 2 to 3 basis points. And if there is no rate cut, next quarter onwards, we can see the inching of the NIM.
Okay. Well, your yield on advances have gone down a bit, and your yield on overall funds also has dipped. But now we are seeing interest rates rise in the market. AA paper and SDLs are fetching a decent amount. You don't think you can make up that loss in loans, EBLR loans, by a higher yield on investments?
But then that will have again impact on the treasury portfolio. Overall, if you see, if interest rate going up, then maybe mark to market, yes.
Okay. So that's not helping. Where do you see growth coming? Will you be able to maintain 14% loan growth?
Yes, I will be able to maintain around 13 to 14% growth. If you see, my majority of the growth is coming through RAM sector. RAM sector, I have grown in excess of 16%. Even retail, I have seen good traction of 18%. MSME also very good traction. We are seeing 16%. Agriculture also 16%, 15%. So going forward, I expect I will be able to maintain growth of 13 to 14%.
Yeah, all your sectors have grown 15 and 16 except corporate, which is 8. So that's why your average is working out to less than 16 to 14%. Is corporate showing any signs of wanting loans?
Yes, definitely. If you see, my corporate loan growth used to be in the range of 2 to 3%. Last quarter, it was around 5%, but this quarter, it is more than 8%. There are few sectors with sectoral based demand are coming. Like in green finance, a lot of demand is coming, whether it is EV or solar power manufacturing, solar battery manufacturing, solar cell manufacturing, a lot of demand is coming. We are also seeing good demand in data warehouse. That is also coming into a big way. Plus logistics sector also we are seeing good demand in the shape of fleet advance and also warehouses construction. So there we are seeing good demands.
Okay. But I agree with you. In fact, situated as you are in the south, I guess data centers and logistics should all be very high. All the auto ancillary guys only seem to want to invest in deep south. So you must have a very good logistics portfolio. But Mr. Binod Kumar, I already noticed that your yield on advances or your cost of funds is actually higher than your cost of deposits, because you must have raised CDs. Do you think the percentage of CDs will go up now in this quarter?
No, if you see my not only CD plus bulk, if I take that has remained at the same level as September. And my endeavor will not to go for the bulk. My endeavor will be to maintain CD and bulk at the same level. Of course, I mean, if there is a very good demand, of course, we can raise. But my endeavor will be to maintain at that level only.
Okay. But it's just looking tough for all the banks. There is a big difference between the advances growth and the deposit growth. In your case, the difference is only 1 percentage point, but for many others, the gap is higher. Okay, I want to come now to what I think is the most difficult part of your presentation. Your SMA2. Why did it go up so much in one quarter? Your SMA2 in the second, as of September, was 2,461 crore, rises to 5,000 crore. What happened?
Yeah. So let me first tell you about the overall SMA book. My overall SMA book has more than halved. It was in December 24, 11.88%. This quarter it is 5.05. So more than half it has. And there are two PSU accounts which is oscillating between SMA 0, 1 and 2. Last quarter it was in SMA 0. This quarter it has come in SMA 2. But I don't see any stress in these accounts, and we are quite hopeful that these accounts will not slip to the NPA.
Okay, I just want to explain to our viewers, when we speak about SMA 2 or SMA 1 are those loans which are overdue, but overdue for 30 days. SMA 2 are those loans which are overdue, people have not paid interest, but they have not paid interest for 60 days. And that is the number that has gone up from around 2,000 crore to around 4,500 crore in the case of Indian Bank. But as Mr. Vinod Kumar points out, it's also important to note that compared to year ago levels, it is half. It was sitting at 7,800 crore. It is, by those standards, down to 5,000 crore. You don't expect a rise in NPAs, do you, sir?
No. Our slippage ratio will be very much under control. This quarter also, if you see, it has come down sequentially from 0.79 to 0.69%. And we are not seeing any stress in any of the sector. Some smaller loans are there, but we have taken that in stride and we account for that. I don't see any, upsurge in the slippage.
Okay. What about, no, because it was SMA 2, 5,000 crore, I'm asking, you expect most of them will pay up by the 90 days?
It has gone up only because of two account, and that outstanding of two account is 3,000 crore. If you take 3,000 crore, it will be the same level, rather improvement.
Okay. So that's the danger part. What about recoveries? You are doing a standard about 2,000 crores in terms of recoveries a quarter. Will that continue?
Yeah, recovery. See, I have given guidance of between 5,500 to 6,500. So far, I have already achieved 5,300. And quite hopeful that the number what we have achieved in the last quarter will continue with that.
Yeah, but credit cost has inched up. Okay, no, sorry, that's last year's. I'm sorry. Let me come to capital. You've used up a little bit of your capital. You were standing close to 17. Now your capital adequacy is at 16. Will you want to raise money now?
No, in fact, see, capital has in fact come down because of we have 2,000 crore 81 bond retired and we have not raised that. So we are comfortably sitting at 16.58, and in March profit will be flowed back. So it will again reach, I think, around 18%. So I don't need any capital, additional capital. And one more data I will just share. My return on equity is in excess of 19%. And my credit growth is around 13 to 14%. So going forward also, I think capital will not be required.
Oh, you think capital won't be required. Finally, how much was the impact of the new labor codes for you? Will there be more of it in the coming quarters? And for the banking, PSU bank sectors in general, is it an impact at all? Normally, do you all have contractual staff?
No, we don't have any contractual staff. Only 15 staff we have, and impact of that is around 55.86 lakhs. Very minimal impact we have. Because all public sector banks, normally we have regular employees and very few contractual employees, maybe in a few tens or 20s or 30s.
Okay, so this quarter you didn't have any impact of the labor code at all?
No, not at all. And going forward also, I don't see much of the impact.
Okay. Did you hear anything about integration, consolidation from the DFS? It was very much the news about 6 months back. Any update on that?
I have heard through media only, not anything.
DFS didn't speak about it? Okay.
No, nothing has been discussed with us. Thank you.
Okay, sir. We will leave it at that. Thank you very much, Mr. Vinod Kumar, and all the very best for the last quarter as well. Okay, so that's the word coming from Indian Bank. It's a good set of numbers. I mean, margins have improved, but it's a very cautious guidance saying that a bit of the margins may be given back because, the rate cut came in December and therefore the loans became cheaper only for a few days. now in the entire impact will be felt in this quarter. So we should expect some pressure on margins in this quarter as well before they start rising. That's the expectation. Well, the other set of numbers, since we are talking about Indian Bank, we should talk about Bandhan Bank. Not a very pleasant set of numbers, but the only point is that it was as estimated. But the expert on the field is Gaurav, and he's here to detail to us the Bandhan results. Go ahead, Gaurav.
Well, as if you look at Bandhan Bank, the results were expected to be weak, and bank has actually reported a bit of a weak set of numbers. Net interest income that declined almost by 5% on a year-on-year basis, while there was a support of 120 crores because of the sale of ARC, and that is the reason why we saw other income going up, and PPOP also declining by 28%, but there was a support. Other than that, if you look at the PPOP, there was once again 120 crores of impact because of the new labor code. So we could say that the gain from ARCs was offset because of the new labor code. But as a result, if you look at provisions, they have declined, and profit declined almost by 51% on a year-on-year basis. Now, what actually is positive for the bank is that first is net interest margins. If you look at net interest margins, they have improved almost by 6 basis points on a sequential basis. This was in line with the street's expectation, but what is positive is that even going ahead, management said that the net interest margins will improve in the next 2 to 3 quarters, and the reason being that the cost of deposit is something that they are actually controlling in a very good way, and that is the reason net interest margins are likely to increase. Second is the credit cost. Now, credit cost has declined almost by 12 basis points, although it is a bit elevated, but management said that credit cost will decline further. They have given a guidance of around 1.6 to 1.7% credit cost next year. So that is something which has been taken in a positive way by the street. As we speak, the stock is up more than 4%.
Okay. All right. Taken positively. Thank you very much, Gaurav, for that update as well. As a whole, actually, public sector banks are doing well. Today, among the gainers is really Bank of Maharashtra, Union Bank, Canara Bank. Public sector banks have rendered a brilliant account of themselves, and they've always had a lower discounting in terms of ROA. So now the market is sitting up to acknowledge that public sector bank quality, especially asset quality, and the steep fall in credit costs in all of them is here to stay. And then, of course, we had the big news that power discoms have turned profitable. That was the single biggest source of NPAs. That also is gone. So public sector banks have clearly got a leg up from this general improvement in asset quality in the economy and in their own books. Market is also punishing where you have got management change news. So Eternal is still a little bit under the weather. Interglobe, people still worried, although most of the brokerages have called a buy after that difficult quarter. So market still dithering. Not in a very fine place at this point in time, though we have seen other markets in the green, Indian markets still struggling to find buyers. On that note, wrap up on Bazaar. Chartbusters coming up.
Indigo's profits take a one-off hit on December disruptions, even as the core business shows signs of resilience. Shares of the airline skid in early trade, down 2%.
Bandhan Bank delivers a stable performance in the December quarter, reporting a slight uptick in the net interest margins. The stock is up close to 5% as brokerages Motilal Oswal and CLSA issue bullish calls.
Robust earnings provide a leg up for APL Apollo. Margins expand, EBITDA per ton grows over 20%. The company is looking to double its capacity by FY30.
Splendid moves on Hope First Finance following a good show in the quarter gone by. A strong all-round performance was aided by a 60 basis point uptick in margins. Return ratios also improve.
Tanla platform skyrockets on the back of strong third quarter results. Margins expand while profits grow 11%, aided by strong top-line growth across segments.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam and a slight tinge of green on the top of the screen. So thanking God for small mercies, Mangalam. Another show we start with some green. It's a Friday. I'm sure you're going to be smashing it out of the park because it's the long weekend as well. But let's hope we end on a stable wicket.
Let's hope we end on a stable wicket. Long weekend, Nigel, but you know, it's also the weekend for Lollapalooza, which we'll be watching a lot of those music grooves and all of that and stuff. And tonight, if you like house music, Nigel, there's DJ Tiesto who plays. You've probably heard of DJ Tiesto. I'm not sure, but as we speak, you know, the Nifty is just flitting.
You're getting me passes for either of those two?
You come along with me. You're my plus one. I'll just tell Sonal that.
Lola, okay.
Oh, okay. All right. On that note, what we'll do is...
I'm saying, but he's already promised to take me. Okay, I'll read it.
A perfect time actually to get speaking to the management of Radico Khaitan, Abhishek Khaitan, who joins in now after, what was a stellar quarter for the company. Yesterday, the stock ended about 6% higher as well. And good volume growth, much ahead of peers. Thanks a lot for joining in, Mr. Khaitan. As we say it in your business, cheers, right? A stellar set, much ahead of peers. So, for starters, can you detail what is it that you did differently for volume growth? I mean, what's a sustainable run rate here?
So, Mangalam, first of all, wishing you and all the viewers a very, very happy New Year. We always believe October to December is the festival period of India. And luckily for Radico, it has been truly a good quarter. In fact, it is the strongest quarter ever. So we had a volume growth of 16.7%, and we did the highest ever volume of 9.75 million cases. And also we had the highest ever EBITDA of 265 crores, which is a jump of 45% in EBITDA. Corresponding to the same quarter last year. Our net profit also grew by 61% to 154 crores. So in fact, what we saw, and most importantly, is our P&A category grew by 25%, which we are happiest about. So the hard work, what we have been doing the last 4, 5, 6, 7 years has started playing, and the premium brands have started now gaining pace for us. And the growth, what we are getting from all across India. So every state is contributing to the growth. And for us, like our P&A brands like Magic Moment Vodka, which is the largest selling vodka of the country and the 6th largest in the world, has grown by 18% in the current quarter. After Dark whiskey has grown by 40%, and Royal Ranthambore has grown by 50% in the quarter. So overall, we have seen growth everywhere.
All right. Hi, Abhishek. Good to see you. Well, let's focus on your volumes. Now, the 9-month volumes are more than 40%. I think that's nearly double of what you were guiding for earlier when we were talking about more than 20%. What would you update, your guidance currently? Do you think you can do even better?
As far as the growth goes, I think in the fourth quarter, we should end the year at a volume growth of about close to about 20 to 25% in terms of volume. And going forward, our focus is more on the P&A category, where we expect our P&A category to grow by 15% for the next 2 to 3 years. So I think that is where our focus is. And as far as the luxury portfolio goes, I think it is doing extremely well and will be close to our 500 target.
Okay, what about your luxury portfolio then? That 500 crores, you're on track this year itself?
See, that we will because if you see in the last 5 years, we have done a lot. We have launched 6 luxury brands, starting from Royal Ranthambore to Sangam to Rampur Barrel Brush, the Spirit of Kashmir, Vodka, Kohinoor Rum, and our latest Virasat Indian Single Malt. So I think the luxury portfolio has a long way to grow. And I think it should grow by about 30%, 30 to 35%.
All right, so luxury growing over 30 to 35%. What about margins then? Because, raw materials are favorable right now for you. You are premiumizing. You will also have to perhaps, increase your spends at some point in time. Your margins have increased. Will you settle at, this 200 basis points increase this year? And what's the outlook for next year?
Mangalam, our margin, if you see, last year we ended at 13.8 and we had guided about 150 basis point. But in the current quarter, our margin is 17.2 and for the 9 months, it is 16.2. As far as I see the fourth quarter going, we expect the margin to be same as this quarter, if not better. And going forward, we expect about 125 basis point increase in further margin if the raw material stays where it is.
Abhishek, cheers all the way. You're sounding very, very optimistic. Now you've repaid close to 200 crores of debt. When you make good amount of money, obviously your debt levels become more comfortable. Will it stabilize at current levels or are you due to be debt-free soon?
See, the company is throwing a lot of cash. So I think debt is least of our concern because our internal working capital would be about more than 1,000 crores. So I think debt is least of our worries. So FY27, I think we'll be debt-free.
All right, you will be debt-free by FY27, least of your concerns. But something that's concerning the environment right now is the regulations, right? Ahead of the budget, are there any risks that you foresee, especially given the recent crackdown that took place on tobacco?
I think everything in moderation is good. And I think I don't see our industry facing that pressure because we are one of the highest contributors to any of the state government. And we've always seen wherever there's been prohibition, there's been always a backlash. So I think our industry is quite responsible. And as far as it has to be, I think we don't see it as a worry.
Oh, interesting. But then what's the next macro trend as per you?
See, I think the white spirits, which I've been always saying that, globally, it is 28%. In India, it is only 4%. We are seeing a lot of traction in the white spirit space where Radico is a leader in vodka, in our gin, Jaisalmer. Indian craft gin has a market share of more than 50%. So I think going forward, I think white spirits is going to gather a lot of momentum.
All right, white spirits going to gather a lot of momentum, Mr. Khaitan. Unfortunately, I'm not the ideal consumer for your product. In fact, you've also in the past said that you're not looking to launch any of the zero alcohol beverages. But whites, Nigel, what are your thoughts on whites? He says globally whites are 28%, in India it's just 4 to 5%. Whites are gin, white rum and vodka. What's your poison of choice?
Gin. I would go with gin actually.
Tequila?
Nice. Tequila as well. Very good. Yeah, and low calories, Mangalam.
Yeah,
so
low calories.
If you ever choose to come onto this side of it, then you can maybe, in fact, go.
And if you choose to come on this side of it, there's just so yeah, there is one of that. Or just so plain soda. Plain soda.
Just come on this side. You're wasting time.
Well, we'll decide that. We'll take a short break. But on the other side, we discuss jewelry after alcohol. Bluestone Jewelers founder CEO Gaurav Singh Kushwaha joins in after the break. Well, ahead of the long weekend, virtually undecided for the market, flitting between red and green, but one stock which is off the highs, significantly off the highs, down about 9% from highs, is Bluestone Jewelry, down 3%. Remember, the numbers were good. Ahead of numbers yesterday, the stock had already run about 11%, and maybe the stock sold off for three particular reasons post their numbers. One, as compared to the reported growth in peers like Candere and CaratLane, the growth of 27.5% was slightly lower. Second part is that there was a large element of inventory gain, which has led the EBITDA to be higher. And the final part is that the stock had already seen an 11% up move ahead of numbers yesterday. That explains this sort of move in an otherwise good performance coming in for Bluestone Jewelry. Gaurav Singh Kushwaha, who's the founder and CEO, joins in now. Thanks a lot, Gaurav, for joining in. Congratulations. The revenue growth was good, EBITDA even better. But what I want to understand is, what's the current unhedged inventory that you're sitting on, and what are the likely gains in fourth quarter because of that? Because between the third quarter and now, there's been a serious jump in both gold and silver prices.
Thanks, Mangalam, for having me. So essentially, what we have always maintained that our inventory, our hedge ratio, are always going to be in the ratio of our equity to debt to kind of protect the balance sheet. In line with that, we maintain hedge at almost 50%. However, another thing to note is that every company, every jewelry company, whether you're hedged or whether you're unhedged, you always have inventory gains. We are the only ones who actually disclose it separately. But even when you're hedged, which means that you're short in futures market, at every rollover, you actually end up making money. In fact, in the last 1 year, any company that has 100% hedged position on their inventory would have made almost 5 to 6% on that, which is generally bundled in gross margins. We are the only ones who separate it out. Now, given the sharp rise in gold price, we have unrealized inventory gains still sitting on our books, and which are going to be unlocked in next few quarters.
Which is what we want to understand the quantum of, sir.
Quantum, actually, it's a pretty, so quantum I can't disclose. We don't disclose that. 50-50 is the hedge ratio that we do.
Okay. All right. Hi, Gaurav. On a personal note, I was wanting to gift both the ladies in my home, wife as well as daughter, something, and I went and gave a little token of gold, but it should have been silver. They would have been much happier. That said, as a percentage of your sales, how much is silver, if you could tell us out there? And there would be big inventory gains there too, right?
We don't deal with silver. We only have gold, diamond, platinum. We don't deal with silver.
So thank you for the clarity then, because that was one of the queries that did come in. Will you be...
So the way we should look at the business is beyond inventory gains, and I understand inventory gains is no one's hand. It's our, at the same time, protecting the balance sheet is very important, and that's why the hedging policy that we have. I think more important is the EBITDA that we have delivered, which we disclosed, pre-Ind AS EBITDA without inventory gains that we disclosed.
Got it. So what is a sustainable number then there? Because you said when you came for the IPO that a large part of your investments are front-loaded, older stores make 24% EBITDA, and as newer stores get older, you will get the benefit of operating leverage. So on a sustainable basis, what is the EBITDA likely to be?
Precisely. So last full year, that EBITDA, which was pre-Ind AS EBITDA, which adjusts for ESOPs, rental and inventory gains, that EBITDA was 1%. In first half of this year, we delivered close to 2 to 3%, and this quarter we delivered 12%. Fully should be significantly ahead of last year.
Okay, so 12 to 15% is a sustainable number.
12% festive, but in Q4 it will drop. But eventually we see our business as, because we operate in high margin categories, so we see our EBITDA to be in kind of mid-teens or between 13 to 15%.
Okay, all right.
At maturity.
Okay, all right, Gaurav, will you be impacted by Titan's foray into the affordable jewelry segment?
Titan had always been there through Mia, through CaratLane and so on. So and Titan's or Tanishq's own portfolio also contains a lot of those products. So it's not that it's something new, that has always been there. So that competition has always been there, and our growth has generally been, I mean, we have been eating significant market share.
Since you spoke about
dynamics.
CaratLane, market share as well. So tell us that those competitors appear to be growing at a faster pace than you, right? So according to you, what is your current market share, and have you lost a one?
I wouldn't say so. So the industry is slightly complicated. So you actually have to look at, so most of the other peers, they actually have both primary and secondary sale. which means the sale to franchise is also disclosed as company sale. So, for example, if you look at CaratLane's last year results also, their reported sale was 32%, but the end customer, their reported sales growth for Q2 was 32%, but the end customer sale growth was only 25%, which was 7 percentage points lesser than that. So I think to that extent, it's very difficult to just compare the headline numbers, and I think it would be wise to actually look for the consumer sales, the growth in actual consumer sales.
We don't have access to the consumer sales data. If you could, Gaurav, then tell us, on a reported basis, you've done about 27.5% sales in the third quarter. Reported basis, CaratLane has done 42%. Candere has done, obviously, on a very low base, 147%. Have you, in the third quarter, gained or lost market share?
See, Candere is very difficult to assess because Candere also is within Kalyan stores, right? So if some piece is sold, and that happens to be a Kalyan piece, like how Mia and Tanish used to operate, where Mia would sell within Tanish stores, right? So it's very difficult to kind of get hold of what is Candere's retail sales force. Another dynamics which plays in such volatile gold markets is that the demand for commodity products, which is coins, chains, low margin bangles, etc., increases disproportionately. So it all depends on who is playing in what segments. We generally play in higher margin segments. We don't have a very strong play historically in lower margin categories. I think there are lots of dynamics, and hence looking at just one quarter when the gold was very volatile, just comparing those growth numbers to assess which company is going faster or slower, I think would be the wrong thing to do.
All right.
So if you look at any of the quarters before that, quarter two, quarter one, and so on,
right,
it has always been strong.
So on that note, let's wrap this conversation with some
also. Yeah. And in December also, so we exited December at around 35%. So as things moderated, as more sanity prevails in gold prices, I think it would be much easier, or it would be a much better environment to predict which company is growing faster. Right.
Okay, irrespective of where gold prices are, that's not under your control, and obviously what the competitors do isn't under your control as well. Let's wrap this conversation with three very simple numbers, all right? Going forward, over the next couple of years, what is the kind of sustainable revenue growth that you foresee, backed by same-store sales growth? That's one. The second part, you've already told us that you are eventually aspiring for mid-teen sort of margins, but ad spends as a percentage of sales. You have leverage there as well. It was 9% earlier, now it's down to about 7%. Where does that number settle? That's two. And the third part, the number of stores that you're going to open. So the number of stores that you open, under your control. Ad spends, under your control. Revenue backed by same-store sales growth, under your control. If you could give us all these three numbers.
Sure. So on growth projections, we maintain, so we have generally been growing at between 35 to 40%. So we maintain the same growth projections in that range, between 35 to 40%, supported by the same store sales growth of between 15 to 20%. So we continue to kind of maintain those numbers. In terms of A&P, we always maintain that there's significant leverage sitting there as we grow more and more stores, and the stores mature. A&P as a percentage of overall sales was going to come down, and it has come down. We will maintain it at around 6%. I think this quarter was around that number. Going forward, we'll maintain it at that number. And the third, what was the third part? Third question?
Number of stores that you open. Currently, it's 275.
The store rollout. So 70 to 80 stores a year.
All right, take that point. Thank you so much. 70 to 80 stores every year. A&P is around 6%. Yes, go ahead.
As a very young brand, we are still significantly under-penetrated.
Yeah.
We started opening stores around 5-6 years back. So it's just a lot of scope of opening more stores.
All right, we take that point, Gaurav. Thank you so much for joining in, giving us an outlook, a peek into what the business is likely to be. We'll obviously touch base with you, sometime during the middle of the quarter to find out how the fourth quarter has been so far. The start has been good. You've said that you've seen mid-teen sort of SSSG and 35% exit run rate in December, which has continued into January as well. There was a big move on the stock yesterday. Currently seeing some profit booking. Take a short break. Come back. More news and updates for you.
Welcome back. Well, the markets have dipped mildly into the red. That's not the problem. The broader markets actually have seen some selling, but you'll still take it. You don't want this market to fall. The rupee as well is fairly stable in today's trading session. So by the end of today, if you have the Nifty model as flattish and the rupee is stable, the bulls will take it after the kind of selling that we have seen. But we have completely run out of time on Chartbusters. You stay with us because the time of trading hour is waiting by.
Good morning. It's a Friday morning on CNBC TV 18. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormuz Fatakia. The market's splitting between red and green, indecisive, and rightly so, because it's a long weekend, and thereafter we have the January series expiry, after which is going to be an eventful February series, because we have the budget, we have the RBI policy meet, and the remainder of the third quarter results as well. So all these factors playing on the market's mind right now after this fairly volatile week that we've seen, where we've tested lows of sub 25,000 and also highs of closer to 25,450. The market is biding time around 25,300. What's interesting, however, is the broader market still in a wee bit of pain right now. We have nearly 1,700 stocks which are declining for about 1,100 stocks which are advancing. Not as bad as what we've seen in the earlier part of the week, but there is some pain from the highs of today's trading session. Both those indices are beginning to move lower and at the lower end of today's trading range so far. A couple of stocks which are doing well. We have HUL, which has been resilient all through this tumultuous period. So up around 2.5% for this week, up 5% this month. Asian Paints, that one continues to do well as well. Oil prices are contained around that $60-65 per barrel mark with better prospects for demand, and having seen a big correction in the stock price already, Asian Paints is higher. And then we are seeing some traction in names like Bajaj Auto and the others. Basically, defensives are doing relatively better. But for all the other top movers in the market, Hormaz has moved across to the wall. Hormaz.
Well, after the kind of week that you have had, you would take some bit of quiet that you are seeing on the Nifty today. Of course, not without its fair share of choppiness. But again, earnings reactions taking center stage today as well. Home First Finance is one name. Well, still holding on to gains of around 5.5 to 6%. It's the third straight day of gains for the stock. It's among the top gainers on the Nifty 500 today. It is the biggest single day gain in 3 months that the stock has seen, with over 13 lakh shares that have been traded. The 20-day average is just around 56,000 shares, and after the move that the stock has had, it is now nearing its 50-day moving average on the upside, which is at 1120. So that's the next level to watch on the upside. But it's been a good performer since its listing. Is almost doubled from its IPO price of 518. In a season of winter, Voltas is doing well in today's session. 4% higher today is the second straight day of gains. It snapped a 6-day losing streak when it ended higher yesterday. It had close to 9 lakh shares that have been traded on Voltas already, the 20-day average being just 1.3 lakh shares. Despite this move, though, the stock remains below its key moving averages, and it's down. It had the last January was a very tumultuous one for Voltas, was down 30% at the same time last year. But this one has been relatively quiet, as from the recovery that it has seen from the lows, it's still down 12 odd percent from its 52-week high levels of 1532. And lastly, Ashok Leyland, which continues to move higher with positive brokerage commentary coming in almost every other day, 4.5% higher today as well as the third straight day of gains. It's up 8% so far this week. The stock has gained in 6 out of the last 8 weeks so far, and over almost close to 1.5 crore shares have been traded on Ashok Leyland today. The 20-day average being just less than 50 lakh shares, so around about 3x its 20-day average already. The stock has sustained above its key moving averages since the month of August. Ever since it broke above its 50-day moving average, it has managed to sustain above those levels. And in fact, for the month of January itself, it's up almost 11 to 12%, turning out to be the best January that the stock has had since 2021, Manglam.
All right, we take that point. Those are big movers. Ashok Leyland, in fact, was higher yesterday as well. And today, we pointed out that there were a lot of long positions being added in the F&O side on Ashok Leyland yesterday itself. But Bandhan Bank, that is among the big gainers in today's trading session as well. What is it that the street likes so much about these numbers? We're going across to Gaurav, currently up 5%. Big move there. Gaurav.
Well, yes, if you look at Bandhan Bank, it wasn't a spectacular show, but once again, it wasn't expected to be a spectacular show either from Bandhan Bank. Because when we look at numbers, net interest income that declined by 5% on a year-on-year basis, almost in line with the street's expectation. There was a support of 126 crores from the sale of ARC in the other income segment. But again, there was another impact of 120 crores because of the new labor codes, and that kind of offset each other. And that is the reason when we look at operating profit, which is PPOP, that declined almost by 28% on a year-on-year basis. Now, provisions, they were likely to decline, and they have actually declined almost by 16% on a year-on-year basis. And as a result, if you look at profit number, that has come down almost by 50%. Now it stands at 200 crores. Although if you compare it on a sequential basis, it has almost doubled. Now, what stood out well for Bandhan Bank is first is their net interest margins. If you look at net interest margins, they have expanded almost by 6 basis points on a sequential basis. Now, this was in line with the street's expectation, but now management said that in the quarters coming ahead as well, the net interest margins will expand, and the reason being that they are actually containing that cost of fund element for the bank, and that is the reason why they are positive about net interest margins. Second is credit cost. If you look at credit cost, it has declined almost by 20 basis points in this quarter itself, 12 basis points to be precise, and at the same time, it stands at around 3.3% level. Now, what management is suggesting is that in FY27, net credit cost is going to be around 1.6 to 1.7% for the entire book. So that is a huge fall that they are anticipating, and the reason being that they are seeing some kind of improvement in the MFI segment, and at the same time they are also increasing their secured book, because if you look at their loan book composition in this year, in this quarter specifically, they have increased their secured book and they are not focusing more on the EEB portion of their book. That is the reason why Street is taking these comments in a positive way. In fact, we also saw brokerage like Motilal Oswal, they upgraded the rating to buy, and as a result, we are seeing some upsurge in the stock price.
Doing well for itself is Bandhan Bank, but Gaurav, stay on because there are a couple of other stocks that you've been tracking since the morning, one of which is Paytm, and that is of course on the back of a positive brokerage note. And Aditya Birla Sun Life AMC at one point was up almost 5% after that double upgrade that came in from Citi. Tell us more on both of them.
Well, two stocks are on our radar, and this is on the back of the brokerage lens. First is that Paytm, because Investec, they have initiated with buy rating and a target price of 1,550 rupees. What they're saying is that Paytm has a deep tech capabilities and at the same time strong merchant relations. Now, this gives Paytm pricing power and impose high switching cost for customer. Second is that they also believe that the acquisition of merchants has already been done for Paytm, which is actually giving them some kind of operating leverage. And given all these factors, they are expecting CAGR growth for revenue to be in the range of 23% for the next 2 years for Paytm, and at the same time EBITDA margin is expected to be somewhere in the range of 24% versus what we have seen at 8% for the first half of FY26. So that's a huge jump that Investec is anticipating, and that is the reason why they are bullish on Paytm. Second is Aditya Birla AMC. Citi upgraded the stock from sell to buy and gave a target price of 900 rupees. What Citi is citing is that the performance has been tapered for the last few quarters, and the reason being that there was a weakness specifically in the equity schemes. But now what they're seeing is that the market share is stabilizing specifically in the equity flows and SIP segment, and they are also seeing some sustainable movement going ahead in terms of the performance of the equity scheme. Other than that, they are also highlighting that they expect the gross flows to pick up quickly. Remember, management is also a bit bullish on the company because management indicated that there will be some reduction in the redemption ratio, and that is the reason why Citi is bullish on the company. They say that there is going to be a stance of wait and watch, but aggressive sales engine of Aditya Birla is something which is helping the company, and that is the reason why they have upgraded the stock. As a result, both the stocks are up in trade, and in fact Paytm is up more than 4% in a trade today.
All right, take that point. Thank you so much for that. Paytm currently off highs right now as we speak. But you know what is at the high point right now is Bharti Airtel. We had positive commentary coming in from Sunil Bharti Mittal from Davos yesterday, and HUL continues to do well. Remember, the company reports its numbers, quarterly numbers, on February 12th. But let's slip into a short break. We'll get chatting with the management of V-Mart Retail. Anand Agarwal, who's the CFO, joins in to decode their earnings. The stock's doing well on the back of what was a decent performance